So we just had a massive update in regards to the overall market that we absolutely have to talk about, especially given where we're currently sitting in terms of the S&P 500, right? From a technical perspective, it looks pretty bearish, but I want to go ahead and provide a few reminders, highlight some of the recent updates and events, and then also highlight this recent report that we got from JP Morgan that I think is going to provide a little bit more insight to this idea of the AI bubble, right? So we know that pretty much the Magnificent Seven has been carrying the overall market, right? So that, those are the names like Meta, Microsoft, Apple, nvda, Tesla, etc., right? And so, a lot of those mega cap names have been pretty much holding up the market, and recently we've been seeing a lot of selling. And if you look on any of the news articles, whether it be Wall Street Journal, New York Times, CNN, even on X, you're going to see a lot of fear and panicking, right? But in reality, what we're seeing isn't something that's too far off from the normal, and you kind of have to zoom away and look at things less from a myopic perspective and realize that we've had a massive run-up since the tariff days, right, in April, right? And what we're seeing here is just a healthy pullback. It's not even a correction. And so I want to go ahead and highlight something here. This is actually from fund manager Ross Gerber. He was mentioning that market corrections are normal and okay, but I responded to Ross on X and I was like, technically speaking, we're not even in a correction either. It's just a small drop, and in which he responded that that's correct, but he's hoping that we do have a correction, right? Now, the reality is, right, and I want to remind everyone the difference between a correction and a bear market. So we're on investor.gov. A correction is 10%. Investor.gov states that generally a bear market is when the market index falls by 20%, right? So that's just a friendly reminder, because when we take a look at the S&P 500 and we look at where we're at from the all-time highs, we're just shy of just a little down of, a little selling pressure, right? We're just slightly down 4%, which is not even half of correction territory, right? I think too many people have gotten very comfortable with the market just always going up. And we have to face reality that that's not absolutely going to be the case forever, right? Things don't just forever go up. That's just unsustainable. And what we are seeing is that, a healthy correction, but we may end up seeing things kind of flip. And I want to go ahead and talk about a couple of things. The first thing I want to talk about is just nvda, right? So we actually had the nvda earnings, and Q3 earnings came up above expectations, $57 billion up, which is 62% up year over year in terms of revenue. Adjusted earnings per share came at $1.30 per share, which is slightly above the consensus. And then, of course, the talk about data center business was really the big driver, and the forward guidance is that it's going to continue expanding, right? And one of the reasons why we want to pay attention to NVIDIA is because in reality, NVIDIA is pretty much the heartbeat of the AI infrastructure cycle. And so if demand were slowing, this is where we would see it first, right? And so that's why the market is pretty much ecstatic of what we saw with the results of NVIDIA's earnings. And in fact, if we look at a 5-minute time frame, we see that right after NVIDIA's earnings, we saw the market start to pop upwards, right? You look at NVIDIA after they had the earnings, it popped up. The overall market's popping up. Now, there's still one major catalyst that we're still going to want to put a major focus on, which is going to be the labor market, which we'll go ahead and touch on in this video. But I also want to talk about this report that we got from JP Morgan, right? So we recently got this report from JP Morgan, and one of the things I highlighted is them saying that yes, tech stocks are driving the market gains, but they don't see it as a bubble about to burst. Now I'm going to go ahead and link this report in the description of this video if you want to read it yourself. I'm not going to, of course, read the entire report because you guys can see this is a long PDF. What they said in terms of, the AI bubble, one of the things that they argued is that it's not likely for it to be a bubble, especially because there's still this huge dichotomy from what we saw from the tech bubble in 2001. See, one of the things we saw in 2001 is, number one, a lot of stocks just popping up with no revenues to sustain those valuations, right? We also had a lot of unused infrastructure like fiber optics in 2001 versus now where we have data centers that are fully used, right? And then on top of that, in this report, one of the things they mentioned, you guys could see here, they're talking about how AI is improving. There's less hallucination that we're seeing in terms of the generative AI chatbots, right? And they also mentioned that GDP, right? The AI spending is only 1% of GDP versus in past bubbles, investments were above 6%, right? So in terms of spending, it's still not technically what we've seen as the peak in past bubbles, right? So that's JP Morgan's perspective. Now, of course, we have to understand that there's a little bit of bias in JP Morgan's report, right? Because of, again, at the end of the day, they don't want their clients to offshore or pretty much sell their stocks. So there's always going to be this kind of bias incentive, right? It's just kind of like when you watch different media outlets. If you're going to watch Fox News, you're going to kind of skew more to the right. You're going to watch CNN, you're going to see it skew more to the left, right? So you kind of have to understand, there's underlying pitch in the narrative, right? But in reality, there's still a lot of positives in what we're seeing in the AI sector. And I believe that this earnings from nvda is pretty much what's going to save the market popping up, unless we see more of a deterioration within the labor market. And one of the things I often share on this channel is how the labor market is essentially the life of the economy, because of, again, spending can continue as long as paychecks keep coming and people can work. But once those paychecks stop coming in, well, now you're not going to go ahead and buy those new Nike shoes, right? And what's going to happen? That's going to bleed into corporate profits. And so you have to understand that at the end of the day, as long as the labor market could, sustain itself, and we see pretty much inflation cooling off as we have been seeing with the trends. Now, I know the government data has been, shut down because of the recent government shutdown, but when you look at alternative data such as Zillow numbers and reports from Redfin, we see that shelter, which was one of the major components of, inflation, is cooling off from those alternative data sources, right? Now, again, we'll want to monitor the upcoming CPI, PPI reports that continue to come in. And really the real concern is what we're going to have from the Fed, right? So we have the next Fed meeting taking place in 20 days, right? It's going to take place in December. And what's concerning is that now the future markets are pricing in a 67% chance that we actually get no cut, right? Now, that's a huge concern because, of course, we are in this restrictive environment and we want to see, easing in monetary policies. This way, it's not so expensive for companies to expand, and that could help, hopefully, provide some relief to a lot of these corporations who are laying off, right? If you can't expand, well, you're not going to grow at the same capacity that we saw back in 2021, where there was just this massive spur of hiring, right? So that's kind of what we want to pay attention to going next. Now, from a technical perspective, what we're seeing in the S&P 500, we are below the 50-period exponential moving average, but we're sitting at this area where we have a lot of volume relative to price, and as long as we could hold above this area, that could be good news, right? So I believe that the bottoming is taking place, unless some massive catalysts with, again, jobs take place that pretty much can cause a push down. Now, if we break below this area of $652 on the S&P 500, that's bad news, right? Because when we have those pockets of volume, that's usually when the big moves take place. And so we want to kind of hold up, which we are holding up. I believe that we're going to have this bottoming phase. And one of the things I've been sharing for those that are insiders within Push and Profit, the Push and Profit Research Insider Group, is that, I expect that, in November, late November, we start to rebound and we have a strong fourth quarter. But of course, if you want to get access to my daily briefings where I share trade ideas, what names I'm looking at, make sure to check out the links in the description below, and also I'll pin it in the comment section, as there's a massive coupon code to join for just $8.99. So for $8.99, you can cancel at any time, by the way. You get access to my daily briefings where I talk more in depth of what's going on in the market, so definitely check that out. But I want you guys to let me know in the comment section below, right? Do you believe that the AI bubble is about to pop, or do you think that there's still a little bit more there's still more legs for the AI infrastructure to continue running before we ultimately stall? Now, again, things don't forever go up. Excuse me. But now I do want to highlight, right, that when we're looking at nvda, right, it also looks like we're bottoming out here, and with this recent earnings, we could start popping up and possibly see nvda go right back to its highs of $212. So that's something that we're going to be monitoring as well. As we mentioned, nvda has a huge weighting in the overall S&P 500, but likely we're going to see a lot of the tech stocks start to bounce up, as there's this relief that, hey, valuations are still there's still something that could hold the weight of these high prices. It's not this massive price that really just can't justify where we're currently sitting at now. One thing I also want to mention is, and let's go ahead and actually look at the upcoming data here. So when we're looking at the U.S. economic calendar, right, as the recording of this video, it's November 19th. We do get employment data, right, which is coming out November 20th. So U.S. employment data, hourly wages, those are things that we're going to want to monitor, as well as the leading economic indicators, which is another alternative data point that the Federal Reserve watches to see if we're heading towards a recession. And so that's really going to be the ultimate catalyst for the ultimate direction of what we end up seeing going next. But with that said, hopefully you guys got some value in today's video, and make sure to hit that like button, and I'll see you guys on that next